You've decided to buy a whole life insurance policy. You're paying $500 a month. You figure that money is going into some kind of growing account, building up your future. So after 12 months, you should have something close to $6,000 in cash value, right? In many cases, not even close. Today, we follow the money, the $500 a month, and show you exactly where it actually goes in year one, and why the cash value story is usually very different from the sales pitch. This is Policywise, insurance explained honestly. The whole life pitch is genuinely appealing. One product that gives you both a death benefit and a growing savings component. Pay in premiums, build tax-deferred cash value, borrow against it later in life. In concept, that's not dishonest. In practice, the timeline of how cash value actually builds is something most policyholders are never shown clearly. The key concept is called front-loading. The costs, commissions, and fees that support a whole life policy are disproportionately concentrated in the early years of the policy. This is why if you cancel a whole life policy in the first few years, you often receive back far less than you put in, sometimes essentially nothing. Let's break down the main cost categories inside a whole life premium. First, agent commissions. This is the largest single cost in year one. Life insurance agents typically earn a commission that's a substantial percentage of the first-year premium for whole life policies, in many cases between 50 and 100% of the first year's premium, depending on the insurer and the specific product. On a policy with a $500 monthly premium, that could be $3,000 to $6,000 going to the agent in year one alone. Commissions in subsequent years drop, but year one is heavily weighted. This isn't a secret. Agents earn more per dollar of whole life sold than per dollar of term life sold, which is part of why whole life tends to be discussed and recommended in sales conversations more often than the numbers alone would justify. Second, mortality charges, which is the actual cost of insuring your life. This is the pure insurance component, what you'd effectively pay if you bought term insurance. These charges are real and legitimate. For a healthy 35-year-old, the mortality charge is relatively modest. For older buyers, it grows. In a whole life policy, this cost is bundled inside your premium invisibly. Third, administrative expenses. Maintaining a permanent policy has overhead, underwriting costs, policy administration, regulatory reserves the company is required to hold. These are real costs, but they're not usually itemized for policyholders in plain language. Fourth, the investment spread. The insurer takes your premium, invests it, primarily in bonds and conservative assets, earns a return, pays you a guaranteed rate on your cash value, which is lower than what they earn, and keeps the difference as profit. The guaranteed return on many whole life policies is modest, often in the range of 2 to 4%, depending on the policy generation and economic environment. When you hear a salesperson say, "Your money grows tax-deferred," that's technically true. But the growth rate, after all internal costs, is often well below what unmanaged index fund investing has historically produced.
There's one more fee category that catches people off guard: surrender charges. If you cancel a whole life policy before a certain number of years, typically somewhere between 5 and 15 years, depending on the policy, you don't just get back your cash value, you get back your cash value minus a surrender charge. These charges are another layer of front-loading protection for the insurer. They've paid out large commissions and incurred significant costs in the early years. The surrender charge recoups some of that if you exit early. The combined effect? If you buy a whole life policy and cancel it in the first 3 to 5 years, you could easily have paid tens of thousands of dollars in premiums and received back a small fraction, or sometimes essentially zero, in surrender value. This is a real financial trap for people who were sold a policy that wasn't right for them. To be fair, some buyers understand the fee structure, accept it, and stay the course. If you hold a whole life policy for 30 or 40 years without surrendering it, the internal fee drag matters less in the long run. The cash value has decades to compound. And the death benefit is permanent, which is the point for buyers who genuinely need lifelong coverage. The problem isn't the existence of the fees. The problem is that they're almost never explained clearly at the point of sale. Buyers often have a fundamentally incorrect mental model of how quickly their cash value grows, and that misunderstanding is sometimes a feature rather than a bug of the sales process. Who needs to hear this most? If you're currently being pitched a whole life policy, ask for an illustration showing your surrender value at years 1, 3, 5, and 10. The numbers should not surprise you. If you already own a whole life policy, don't automatically surrender it, especially if you're past the contestability window and have built up real cash value. A bad policy held long enough can recover. Get a policy review from an independent advisor with no commission stake. If you're a parent being sold a child life insurance policy, child whole life products exist and carry the same fee structure. Weigh this against other savings vehicles. If you're self-employed or a business owner being pitched a buy-sell agreement funded by whole life, these have genuine uses, but you still want to understand the fee structure you're agreeing to. The hidden fees in a whole life policy, agent commissions, heaviest in year 1, potentially equal to your entire first year of premiums, mortality charges for the actual insurance, administrative overhead, the investment spread between what the insurer earns and what they credit you, and surrender charges if you exit early. These don't make whole life universally bad, but they make it essential to go in with clear eyes. The cash value growth in the first several years will likely be far smaller than your total premium payments. Now you know why. Next episode, a question that gets a lot more nuanced answers than you'd expect. Do you actually need life insurance if you're single with no dependents? The answer surprises most people. That's coming up next. Subscribe for one honest insurance breakdown every week. This is Policywise. General education only, not financial advice. Talk to a licensed professional before you buy.